francophonie. And why? Well, first of all, because French is a beautiful language and France has a very rich culture. Mostly for us as the French Chamber of Commerce, because France is a very important country for the Dutch economy. And on the other hand, the Netherlands has great opportunities for French entrepreneurs as well. We know that the Dutch love France as their holiday destinations, but they're more prudent to do business. And I think that should change. And I think it's a language and culture barrier. And it's also just a lack of knowledge sometimes, but there are so many opportunities. So we, of course, as the CCI France Pays-Bas, we really think that the Dutch should work more with the French. And in fact, the same goes for the French. I don't want to say that the Netherlands is their favorite holiday destinations, but I still think that it's a very important country. When they think of going abroad with their business, they don't really think of the Netherlands first, but there's a lot of interesting aspects of the Dutch economy as well for them. We promised you the opening of our French ambassador, Louis Fazi, but unfortunately he had to excuse himself, so he really sends sincere apologies. He had to go back to France now with the crisis in Ukraine. And speaking of this war, although we found our freedom again here in the Netherlands, let's not forget that in another part of Europe, people have lost their freedom. And yeah, I just want to say that our thoughts are with the Ukrainian people, of course. So this first event of this week is in partnership with PwC on tax developments in France and the Netherlands. And we have the luxury to have both experts from PwC France and from the Netherlands. And I will introduce our speakers to you. From the French-Dutch tax desk in the Netherlands, we have Jan-Willem Toen, who is Senior Director, and Vee Govers, Senior Associate. And from the French-Dutch tax desk in France, we have Eve Castex, who is Partner, and Romain Bureau, who's Associate. So thank you all very much for being there. Welcome. It's great that you would like to share your expertise with us. It's important. Fiscality is always a very important issue or challenge, we can say, for a lot of entrepreneurs. For the audience, you can already ask your questions in the chat. And at the end of the webinar, you can also have the opportunity to directly ask the questions to our speakers. So I'm going to give the floor to Jan-Willem Toen, who's going to start with the first part of the webinar. Jan-Willem, it's up to you.
Excellent. Thank you very much, Sylvie. Thanks for having us as well. A very warm welcome on behalf of PwC as well. Last time we hosted a similar event in our offices with nice French croissants and a very nice atmosphere. So it's a shame actually that we need to do it this time through WebEx, but I'm sure there will be a next time, and you're more than welcome to visit our offices. Yeah, I would like to invite you to ask all your questions that you have in the chat, as Sylvie mentioned, and we're just going to take you in an hour, a bit over an hour, through the main developments that are relevant for Dutch and French entrepreneurs when doing business in each other's countries. And we thought we make it a kind of a session, an integrated session, because much more of the activities nowadays are EU-based and much more of the legislation is also EU-based. Before going into a bit more detail, first would like to join Sylvie in her sympathy as well to the terrible situation that's currently going on in Ukraine. Seems a bit irrelevant to start talking about taxes in this time, but nevertheless, we will do so today. But our thoughts are definitely there with, I'm sure, your colleagues as well, our colleagues, and all the people there. Let's move on. We have an agenda today with where we start with the EU developments. We're going to touch on the French developments and on the Dutch developments, and there is plenty of room for questions and answers. Why do we start with EU developments? Well, there's a lot going on. Effectively, the EU, from a tax perspective, has been quite ineffective for a long period. But we do see, following the financial crisis in 2008, 9, 10, we do see very significant developments. And we believe those developments are even strengthened by Brexit, because the UK was known to be, well, not the most enthusiastic country to support European legislation. So giving you a bit of background there. So we saw the start in 2011 of more administrative cooperation between jurisdictions. It started off with the Directive on Administrative Cooperation, and these have been, well, a lot under the radar, I would say. But bear in mind, this is 2011 and we had the first directive. We're now talking about implementing DAC 7. So in 10 years' time, we have 7 administrative directives. The 8th one has already been announced, and I'm pretty sure the integration of data flows will continue even in a steeper pace. We also noted a discussion that started off in the financial crisis on aggressive tax planning and companies, large companies especially, paying their fair share. That has all resulted in a lot of OECD legislation, but as not all EU countries are member states of the EU or member states of the OECD, the EU converted that in their own legislation via anti-tax avoidance directives. And we do see that the EU tends to take that even one step further. So we do see from 2011 through 2016, 17, where non-cooperative jurisdictions lists have been published, but also the EU courts, as we mentioned here in 2018, they added very significantly in the integration of European tax. Having said that, that's of course the past, and it's much more interesting to talk about the future. What can you expect? And you see a horrible timeline here of European legislation which is coming out. And the EU has discovered itself in, well, making difficult abbreviations like DEBRA and BFIT, ATET 3, we have CBCR, we have Pillar 2, a lot of difficult terminology. We just want to take you through the main developments here. So we're not going to touch on all aspects of that, but this is just a 2-year window, and you will already see what is coming out. And just a couple of points I want to touch upon. We will go into a bit more depth on ATET 3, which is an anti-tax avoidance directive, and we're not going to talk very technical about it, but just what are the practical implications. But you'll also see on the left top side, public country-by-country reporting. EU wants to become more transparent. Where are companies paying their tax? You need to make that public, and that, well, is a trend that we see continuing. I also think an important one is the bottom one, the directive on proposals for own resources. The EU did not have any own resources. There's no European taxation yet. I think Brussels would love to have their own tax. Most member states were not so much in favor. But finally, there will be own resources for the EU. So some first steps for European taxation are taken there. Where will that end? Well, if you take a look at a bit further right, you will see the word BFIT. And BFIT stands for Business in Europe, a framework for income taxation. It's effectively a European corporate tax to be published by the end of 2023. A lot of attempts have taken place in the past to come to a kind of European corporate taxation. And why is this chance much more successful than the previous ones? Well, I think 2 things there. One, the Brits were known to be always against this type of movement. That has fallen away, so the dynamic is definitely different, politically speaking. Second, a lot of the anti-abuse legislation has already been harmonized. So the step to a kind of a framework for joint taxation has become much smaller. So it's an interesting one to see where things are moving to. And especially also given the current French presidency for the European Council, where we expect a lot of steps will be made in the next few months on European taxation. I will start focusing on ATAD 3, so an Anti-Tax Avoidance Directive, and fully understand if you don't have a lot of detail about it, so we will try to explain that very simply. Faye, do you want to move over to the next one? Yes. This is a very simple order of steps. What is ATAD 3 about? So the Anti-Tax Avoidance Directive number 3. It's about identifying which companies are potentially in a situation to abuse tax legislation. And what kind of companies are we talking about? We're talking about holding companies, financing companies, royalty companies, in general, low substance entities. These entities are being targeted as step one. We need to identify which companies that are. Well, a lot of French multinationals in the Netherlands, for example, will have operational activities. As Sylvie mentioned, there's a big business interaction between the countries. But a lot of those companies also use holding companies. Well, this legislation is aimed at holding companies and at denying benefits to those holding companies. Even one step further, it may result in double taxation. So step one here is effectively the gateway. Identify those entities which are at risk of abusing the tax system. Many companies will fall within that. And then we come to a more detailed assessment, effectively including, as always within the EU, a lot of information sharing. So if you're a company potentially at risk, there will need to be some reporting. And if you don't meet strict criteria, there will be the presumption that the company is misusing or abusing tax treaties, for example. There is the possibility to rebut that presumption or claim an exemption if you can demonstrate that the intention has not been gaining a tax advantage, or if there is actually no tax benefit. The consequences, as I just mentioned, are mainly the denial of benefits. For example, zero withholding tax under treaty, potentially exemption under the participation exemption that could become in scope. So these type of significant tax consequences. And all of this, if you are a company that is at risk of potentially abusing tax legislation, all that information will be exchanged. So there will be a whole data stream coming out. And I already see here that what would be relatively easy, French company making a payment to a Dutch entity, whether that's a dividend distribution or so, it's easy to request for information on the substance of that entity. Okay, moving to the next one. So the theoretical framework, I just explained those 7 steps. Zooming into a bit more detail, and then the gateway, which companies are at risk? Well, the European Commission effectively said, we deem those companies with not too much substance itself, with a lot of cross-border activity, with relevant, mainly capital income. These companies can easily make use of different tax systems and can easily be moved from one jurisdiction to another. So these companies, we believe, cause the possibility of misusing the system, especially those ones that outsourced a lot of their activities. So what you read often in the newspapers, Dutch holding companies being managed by trust entities, so external directors, outsourcing a lot of operations and just holding shares or holding loan receivables. those are generally speaking, the companies that we're looking at. And well, what are other relevant criteria there? Like, for example, is the company having its own premises, a bank account within the union, and does it have its own directors? It sounds maybe relatively easy for a French group doing business in the Netherlands that has operational substance here, that you should not fall within the scope of this legislation. I think that's a too simple way of looking at it. Also, those operational groups which make use of holding companies could fall within this legislation. Maybe the next one, Faye. So what are the consequences effectively of this legislation? And it's quite far-reaching. So there will be a lot of information exchanged. So every taxpayer within the EU almost will need to assess whether they fall within the scope or not. And if they fall within the scope, information about the entity will be exchanged. That also means, and that's the most far-reaching one I have seen so far, is that member states may ask other member states to perform a tax audit. So the French authorities, for example, can go to the Dutch tax authorities and ask to perform a tax audit on a holding company, for example, on a shell entity. And they need to start that audit within 30-day period. So that's well, quite extreme quick within the EU. And that's also where the Netherlands already said, well, that may be a very big challenge, given the number of holding companies, for example, we have. What would it also lead to denial of a tax residency certificate? Effectively, if you want to apply a 0% of withholding tax, a residency certificate is being issued normally to confirm that the withholding tax can indeed be reduced to 0. That may be denied if that residency certificate shows a clear health warning. So the Netherlands will, in a lot of situations, issue a residency certificate that says, well, this entity is incorporated under Dutch law, but it is not meeting the criteria of 8.3. And that's an open invitation to other jurisdictions to say, well, if you're not meeting the criteria, we will not apply the benefits of tax treaties or European directives. So that automatically brings it back to the fourth point here, the denial of tax benefits. But also there may be an indirect inclusion of the income of the shell company at the parent level. So what does that mean? Effectively, a company making a dividend distribution, for example, to a Dutch shell company, that company may deny reduction in withholding tax, but at the same time, the shareholder of the Dutch shell company may also charge the income that the Dutch company earns directly into its own tax system. So there's a risk of double taxation depending on how the individual countries are going to implement this. So it's a very relevant point. Lastly, and I think that did not get a lot of attention yet, but non-compliance with the provisions can end up with a penalty of 5%. We did not see a lot of harmonization of penalties within the EU, but 5% of the turnover, depending on your definition of turnover, can be a very significant amount. I just want to skip this one, Faye. There are some examples here. I think it is interesting to take a quick look at what the different jurisdictions do or think within the EU. Because substance has been a subject that has been discussed a lot over the last few years. And all individual countries have their own regulations, or maybe a choice. They choose not to have specific legislations on that. And what is 8.3 doing? Bringing together those definitions in a form of a EU minimum standard that you should have for substance. We typically see two kind of countries. The large economies, like for example, Germany and France, who are pretty keen already that any payments made to another jurisdiction are made to an entity with a lot of substance. And we do see other jurisdictions like Ireland, Luxembourg, I would say the Netherlands as well, who have a lot of those holding companies who, well, tend to have well-balanced substance requirement, or maybe very little substance requirements. So the tendency or the aim of the European Commission is to align this and come up with a joint minimum. It's also where we see some pushback. For example, the Netherlands government said they're in favor of this draft directive. Luxembourg was opposing it. Why? Clearly, their economy will be affected. Maybe to the next one. So there are some questions coming up. It is a draft directive, which we expect to be a final directive soon and to be enacted already per 2024. That sounds a bit far away, 2024, but please bear in mind that the reference period on the basis on which the assessment is done, whether a company falls within the scope, that reference period is already 2022. So we're already in that period. There are quite some questions. Is this a proportionate measure from taking into account the different substance criteria, but also does it affect our competitiveness with other countries, other jurisdictions outside the EU, clearly the UK, for example? Well, I can tell you that there already are thoughts of an ATAD 4 aiming at shell companies outside the EU to create that level playing field. Yeah, maybe F, do you want to add something on the French perspective on ATAD 3? Are you also supportive of this initiative of the European Commission?
Yes, of course. Thank you, Jan Willem, for this very detailed presentation, very clear. Hello, everyone. Good morning. So regarding our French view on ATAD 3, it is true that we have, as of today, unofficial substance requirements. So the tax inspector are relying on our prolific case law, and we had prolific case law for the last 2 years. So it is really on a case-by-case basis. So we have to analyze the fact patterns. But for the tax inspector, it is quite easy to manage to get huge reassessment based on the case law, either on substance or beneficial owner concept. So what does ATAD 3 proposal bring to the table compared to the existing system? So in my view, I believe that because the rule is more objective, maybe it will be more predictable for tax inspector and for corporations to understand how it works now, and maybe it will be easier for tax inspector to get a reassessment because now they will have a very objective rule. However, we believe that the French tax administration could continue to apply its own measures, even if the company does not qualify as a shell company under the meaning of ATAD 3. We anticipate as well some discussion regarding the assessment because the different tax authorities could have a different view on the shell company. So maybe we will have conflict between the different administrations. And of course, regarding the 5% penalty, we believe it is really important, and there is a gray area regarding the definition of the turnover, because do we have to take, for instance, dividend, because in principle, this is the turnover of the shell company. So sometimes the shell company do not have any operating turnover, so it needs to be clarified.
Thank you.
Yeah.
Let's just take a look at the key takeaways. I think there are some really important ones. This applies to all undertakings. So we see a lot of the new regulation coming from the European Union to apply to large businesses. Large businesses often defined as turnover of 750 million or more. Think about the CBCR, for example, certain or the public CBCR as well. The large companies regimes, and we do see that 83 will apply to all companies. I do see a quick question here. Yes, you will get a copy of the slides afterwards circulated, so I think that's it's a good point to mention here, so you don't need to make a lot of notes there. So it applies to all undertakings. It has a retroactive effect through the testing criteria, which are already pending at the moment. And it's quite often, actually, that a Dutch company makes use of an external director, a trust office. So what is at risk? If you're using external directors or a trust office for outsourced activities, that could even be certain circumstances within the own group, you may already fall within the scope here. Definitely, but that's also a tendency, I would say. This leads to well, potential additional taxation, but in any case, it will lead to a lot of extra compliance burden. And what we've seen over the last few years is a significant increase in compliance burden, where in the past maybe it was just a matter of filing a local tax return. We now already have the master file, local file, the transfer pricing obligations. We have ATED2 documentation, which we will touch upon. So more and more compliance burden comes to companies. It is good to mention, before we go to the French takeaways, we do have a detailed webinar on this as well on the 12th of April. We will add a link to that when we circulate the slides as well, in which we go into a bit more detail and also have some other jurisdictions explaining their view. Eve, your French perspective on this, the key takeaways.
Yes, we are perfectly aligned with you, Jan Willem, but if we can add 1 or 2 points. Well, as you mentioned, we have to comply with the requirements to the 2 years preceding the implementation of the directive. So it means that we have to anticipate this minimum substance question as of now, so 2022. As well, it is important to monitor the implementation of the presumption of the minimal substance or the lack of minimal substance and the rebuttal certification as well, because we can see that from a practical standpoint, the burden of proof will be either on the taxpayer or the tax administration. So it will be like a table tennis game. So it has to be closely monitored. And yes, maybe it is necessary to clarify a little bit the definition of a shell company because we know that it could cover very fully legitimate structure, so we need to clarify this point.
Excellent, thank you. I'll just, we have 2 examples here, but I will just use one, and the other one is for your reference if you want to take a look at that in the slides afterwards. So take a quick look at an example here. Let's say we have a US topco, we have a Dutch company holding some intellectual property, and some EU subsidiaries, which can be Dutch and French, for example. So how are you going to approach something like this? Well, in this situation, the Dutch company is receiving income, royalty income, and it's making onward payments quite often. And since it is receiving cross-border income, and a significant part of its activities is that royalty activity, you would very easily fall within the gateway test, because this is exactly the type of company that the European Commission is targeting. Internationally active, with capital aspects which can easily move between jurisdictions. So then we have to take a look at the most important one, and that's the third one here. This specific company has various Dutch tax resident directors that exclusively work for the IP company. They have genuine activities and payroll amounts to more than 100,000 euros annually. You will recognize that 100,000 euros is a test that's currently in Dutch legislation. The test for the European Commission does not mention those type of amounts. The only thing which is important there is that those directors are effectively only working for this company. So if these are just local directors only working for the IP company, that should be fine. However, what is the most common way to structure these type of things? That is that the IP company is being managed by trust offices or with shared directors from other entities. If that is the case, then that also means that the gateway test is being met, and the company is, well, red flagged effectively as a potential abuser of tax law. So this is just to give you a bit of a flavor there on what are the aspects that you need to take a look at. Okay, I would like to finish off this bit of ATAD3 and move to a very important second route of travel, I would say almost. The OECD coming up with taxation on large companies called Pillar 2, and they just transformed that into a European directive as well. Faye, may I give you the word, please?
Sure, thank you, Jan-Willem, and good morning, everyone. We will very briefly touch base on Pillar 2 because we think it may have a big impact, but it's quite complicated. So in the interest of time, we will not walk through all the examples and calculations. Well, the EU issued a Council directive on ensuring a global minimum level of taxation for multinational groups in the Union, or shortly called Pillar 2. And they did do that in response to an agreement that has been reached last summer on a new international corporate tax framework. And basically, Pillar 2 introduces a new effective tax rate calculation, which needs to be performed in each jurisdiction, regardless of the domestic tax rate. And if the Pillar 2 effective tax rate is below 15%, a top-up tax will be payable. And this effective tax rate calculation deviates significantly from existing calculations, and therefore a domestic tax rate above 15% does not guarantee that no top-up tax is due. So that is quite an complicated exercise that needs to be done. And if a top-up tax is due, it will be allocated to the parent company under income inclusion rules. And those will be introduced as of 2023. That is more or less comparable to CFC legislation, where the shareholder includes the interest from the subsidiary income, or to the extent that this is not possible, it will be allocated to other group entities based on the under-tax payments rule, and that will be introduced as of 2024. And it is expected that in Q3, so as of this summer, the legislation will become available for in domestic situations. So within a few months, we know more about this from a Dutch perspective. And the scope and takeaway, when does this apply? The revenue, there's a threshold. As Jan-Willem already said, there's often a threshold used. It applies to multinational group companies with a consolidated annual revenue of 750 million euro. Or more in 2 out of the last 4 years, and that should be based on consolidated financial accounts or deemed financial accounts, and consolidated accounts should be adjusted to an acceptable standard. And please note that not having financial accounts in a format that falls within the Pillar 2 rules means that these accounts should have to be made, so that is also an extra compliance burden. And it applies to groups, to constituent entities. That's a specific definition Pillar 2 uses, which are related through ownership or control, and that is based on financial accounting standards. And the location, which entities are in scope, entities in at least 2 jurisdictions or domestic groups within the EU. So I think the main takeaway for now is that if the threshold of 750 million is met, you should review all jurisdictions where you are located and need to recalculate the effective tax rate for Pillar 2 purposes. And in addition, it also brings a lot of compliance obligations since you have to file several items in the local jurisdictions. So if the threshold is met, I think it would be highly recommended to take a closer look and take timely action. Another point that is quite relevant is ETA 2, and of course that has already been introduced. But it's mainly important now that the ETA 2 documentation comes up, because that should be available when the 2020 tax return should be filed, and that is, or it is already filed, or the filing deadline is very soon now. So ETA 2 entails to neutralize hybrid mismatches based on hybrid financial instruments. So for example, a loan which country A sees as a loan and country B sees it as equity, leading to a, for example, deduction and no inclusion on the other side. It also targets hybrid entities and mismatches between permanent establishments. For example, country A sees it as a permanent establishment and exempts it, and country B sees it as no permanent establishment and doesn't tax it. So that is ETA 2 very shortly, and you should bear in mind that the mismatch should only be related to a mismatch in an entity or permanent establishment or instrument. So if, for example, you have a deduction here and an inclusion in the other countries against a rate of 0%, not leading to tax, that does not fall under the scope of ETA 2 because that's not due from a mismatch. Then we have 2 simple rules. The primary rule is that the payer state who is making the payment denies the deduction, or if that is not possible because there's a third country involved or whatsoever, we have a secondary rule, and the payee state, so the recipient, includes the income. So the main thing with the ETA 2 documentation is that if you have any of these mismatches within your group, you should document that. However, also when you do not have any of these hybrid instruments in your group, you still have to document it. So even though you do not have these mismatches, you should have a document substantiating that you do not have any hybrids in your structure. That's maybe a little reverse thinking, but you need to have that at the moment you file the tax return. This documentation can be very extensive if you have a lot of hybrid instruments or entities in your structure, but if you do not have them, you can most of the time fulfill with having a global structure chart, an analysis of the payments made to group companies, including the countries where they are located, and then you can have a framework of that. But if it's more complicated, you can also include opinion on the applications of foreign law, foreign tax returns, showing that a payment is indeed included in that country in the taxable base or whatsoever. So just remember that ETA 2 documentation should be available as of the 2020 tax return, even though you do not have any hybrids in your structure. I think now we reach the French developments. So
yeah, maybe one final thought, or say thanks very much. I think if you take a look back at the 3 points that we just discussed, ETA 3, Pillar 2, ETA 2, we see one thing actually, and that is it's all legislation aimed at companies to make sure that they pay their fair share. And how is that achieved? Through very technical legislation and a lot of information exchange and compliance obligations. So I'm getting a bit worried, to be honest, because I'm a tax lawyer for the last 20 years. And if I read the legislation on Pillar 2, that's the most complex piece of legislation I've ever seen. And that is even before the implementation, because I'm sure the implementation will be much harder even. So what is the message here? I think being on top of the ball on all these developments and also making sure that your compliance function is ready for an enormous additional load of compliance obligations in different territories. That's crucial for the next few years. So just wanted to mention that one. And now we go to the fun part, and that's French tax developments. Right, FM Romain?
I will try to be very funny. It might be one last point on Pillar 2. It is important so to involve tax experts, but also consolidation experts, because it will be taken on consolidation on the consolidation side. So it is a huge project actually to set up Pillar 2. So France, so today the agenda, so we will cover the general landscape, French tax landscape. So it's a reminder. Then we will address some hot topics, and then Romain will present you some interesting, I think two different case law that have been recently issued by the French Supreme Court. So the fiscal tax landscape. So we can say now that we have a competitive fiscal climate, because as from January 1st, 2022, our corporate income tax rate is 25%. So we have a gradual decrease initiated as from 2017. So now the tax rate for all companies, medium, big companies, would be 25%. We have the tax group regime implemented for, I would say, more than 20 years now, something like that, which cover vertical tax group and horizontal tax groups as well. So it allows to combine profits and losses and to make some tax savings. We have the possibility to carry forward tax losses indefinitely, but there is a capping rule. You can offset the losses up to 1 million plus 50% of the taxable result exceeding the 1 million. I think that Jan will explain the rule, because you have copied the French rule. If you want
we actually did.
And it is important to say that we have the change of activity rules, which is provided by the French law. We have very objective criteria. So if your company is subject to the change of activity rules, then it can jeopardize your tax losses. Of course, we have a wide network with 130 bilateral tax treaties, like the Netherlands. We have a broad participation exemption regime, either on dividends and also on capital gains. So for dividends, the exemption is either 99% or 95%. And for capital gains, it is 12%. You have 12% of the gain that is taxable at 25%. We have also withholding tax exemption, so based on the EU law implementation. So for dividends, for royalties as well. We don't have any domestic withholding tax on interest. We are fully compliant and aligned with the international development in the OECD and EU, of course. Really aligned, and it is one of the priority of the French presidency of the EU right now. And of course, one last point, we have a very competitive R&D climate, because we have a lot of incentives, like the patent box regime, which is applicable to net income deriving from patents and software, and then you can get a 10% corporate income tax on this net revenue. So it is really interesting. We have our, I would say, historic R&D tax credit at 30% of the expenses realized in France. So that's it for the, I would say, the French landscape. Regarding recent international developments, as I mentioned, we are fully aligned with BEPS, with Pillar 1, with Pillar 2. We have implemented ATAD 1 in 2019. So our interest, net interest expenses can be deductible up to 30% of the tax EBITDA or 3 million if the company is not sin capitalized. If it is sin capitalized, all the rules will apply. And after 2 years or 3 years of application, we can see that the ATAD 1 rule is more interesting for French companies than the 25% general haircut that was applicable before. Regarding ATAD 2, so thank you, Faye, for your explanation. It was really clear. So it is true that it tackles all hybrid situations. I mean, all payments as well, not only interest, but also royalties, losses, cost of goods. So it is really wide. And we have, in fact, the law has been implemented as from January 1st, 2020, but we get the French tax administrative guidelines by the end of 2021. We were expecting for those guidelines to have some clarifications and to know what we should bring in the documentation. But I would say that the guidelines are a bit disappointing. They really stick to the law, so we just have to apply the law. Regarding DAX 6, so disclosure of aggressive tax planning with certain hallmarks, we have implemented DAX 6 last year, so in 2021. It is important to disclose the months before the implementation of the transaction. And the penalty is 10% or 10%, sorry, 10,000 euro. And in case of repeated offense, it can be more, and there is a maximum of 100k euro of penalty per year. So it is not really dissuasive, I would say. DAX 7, so compliance for digital platform, will enter into force in 2023. New measures regarding international developments provided by the Finance Bill for 2022 is the possibility to compute withholding taxes on a net basis. Before it was on a gross basis. As from 2022, it will be on a net basis for services provided or used in France and also for dividends. Regarding other interesting developments provided by our Finance Bill for 2022, we have now the possibility to get a deduction on the amortization of goodwill, which was not the case so far. But just to explain the situation, according to French accounting standards, the goodwill is deemed to have an unlimited period of use, and therefore it is not possible to amortize the goodwill from an accounting standpoint, but it is a presumption only that can be rebutted if you can demonstrate the limited period of use, and then you can amortize from an accounting standpoint over, for instance, 10 years. From a tax standpoint, there is a general principle. You cannot take a deduction on this amortization. However, in order to relaunch the French economy, it has been decided to authorize the deduction of the amortization on goodwill for businesses acquired between January 1st, 2022 and December 31st, 2025. So it's a temporary measures, but it is an interesting one. Another measure, so we we have a new research tax credit. So we have the former tax credit, no change, but we have also a collaborative research tax credit that amounts to 40% of the expenses or more for small and medium entities. And it is applicable with qualifying agencies, expenses invoiced to qualifying agencies, up to 6 million euro per year. Last point we wanted to mention that is interesting, the French tax authorities look for giving comfort or security to taxpayers. And then they have implemented a new measure that is really successful as from January 1st, 2021, which is the examen de conformité fiscale. What is it about? In fact, you can ask a third party, tax advisor, a chartered accountant, statutory auditor to perform a tax review for 1 year on 10 points, 10 specific points that are listed in the law. Example, rules for determining the depreciation, exceptional expenses, compliance of your e-file. So you have 10 points and you can get a certification on your 10 points by the tax expert. If you face a tax audit and if the French tax authority do not agree with the position taken, you cannot suffer any penalties or late interest on the points that have been certified by the tax advisor. So it is important to have in mind this rule because it gives again comfort to the taxpayer, and it is really successful in France. And that's it, I think, for the French developments provided by the Finance Bill. Romain will present two important case laws that have been commented a lot by the French tax specialists.
Okay.
Hello, everyone. So, as you said, we wanted to introduce or present two significant developments that occurred in French case law. So the first one that was mentioned during the presentation by Jan Willem concerned the beneficial ownership. So, as you may know, there have been significant development at EU level in the last years with the EU CJ and the ETA 3 directive as well. So in France, in the last 3 years, French courts ruled several unfavorable decisions to taxpayers by basically tackling conduit companies. And in brief, without entering into much technical details, by limited double tax treaty benefits or provision relating to mitigated withholding taxes or exemption on withholding taxes, and limiting as well domestic exemption on dividends or royalties, because as you may know, France implemented the EU directives by referring to the beneficial ownership concept. So what is happening right now during tax audits or before French courts is that the courts basically consider that conduit companies cannot benefit from those exemptions and without any need of abusive situation. And the courts refer both to a legal interpretation of the beneficial owner and an economical definition of the beneficial owner. So in the context that was mentioned, and most notably the ETA 3, there is a need to clarify in the near future how to articulate the French existing arsenal with the proposed directive and how France will have to amend basically its domestic rules. Because right now, what we can see and understand from French rulings is that there is no need for the French tax authorities to look for the real beneficial owner, whereas the ATAD 3 will probably provide for such rules. And incidentally, there is also a need where this situation has to be clarified in a context where the real beneficial owner is a French company. So there is a context that has to be improved and that has to be articulated with the upcoming ATAD 3. So the other significant case law we wanted to present concerned the French participation exemptions on capital gains that Yves just presented you. And so, as Yves said, there is in France since 2007 a participation exemption on capital gains for capital gains that qualifies as such capital gains, and basically it's an 88% exemption. Well, it was not clear until the French Administrative Supreme Court ruling of November 2021 whether the participation exemption provided for a full exemption and an add back of expenses and costs related to the holding or acquisition of shares, or whether it was just an 88% exemption. And it had been debated for decades right now between tax practitioners and the FTA, whether it was CIT, a reduced taxation of the capital gain, or an add back of a lump sum. So the French court in November 2021 ruled that the French participation exemption provided for a reduced taxation of 12% of the capital gain, meaning in 2022 a 3% effective taxation. So this case is really important in France and in an international context, and it, of course, raises or offers the opportunity for taxpayers to offset any foreign tax credit on any capital gain. So it will have to be monitored in the near future, and opportunities maybe, but also maybe it offers the right for taxpayers to claim and seek an offset of tax credit for the past 3 years, which is the timing we have to claim for such reimbursement.
Maybe one last point regarding the French case law. We are expecting a decision within the same direction of the Supreme Court as well regarding dividends, because we have a participation exemption on dividends, and we have the same decision from the Administrative Court regarding dividends, and we are expecting for the confirmation by the Supreme Court regarding dividends. Okay, so really few words regarding the French government priorities to share with you the global trend. So as you know, the context is really specific this year because we have the presidential election to be held in April and May 2022. So as of now, we have some tax programs issued by candidates, the different candidates, but they are mainly oriented on individual measures like wealth tax and so on, nothing on corporate income tax. We know that Emmanuel Macron will share his full program on Thursday, so we will know more maybe about its tax program. We know that he would like to continue the decrease of what we call impôt de production, so CVAE, CFE, so business taxes should reduce, even if it has been reduced by half last year. Otherwise, we expect to maintain the 25% rate. And regarding the French presidency of the European Council, so for sure the presidency supports the priority of the implementation of Pillar 2. This is the high priority of the French government. And also we will continue the administrative cooperation, and the government wants to continue fighting against fraud and tax evasion. It's on the agenda of the French presidency, of course.
Well, thank you very much, Romain and F. And now I will continue with the Dutch developments, and I will start with some highlights, maybe already known to some of you, but I think it's good to mention that as of 1 January of this year, the corporate income tax rate has been increased with 0.8% to 25.8%. However, the first 395,000 euros are only taxed at 15%. So that is a big change. And in addition, just the general highlights, we have, I think it's more or less all the same to France, but we have a fiscal unity regime. We have a wide network of tax treaties avoiding any double taxation. What is interesting in the Netherlands is that you can obtain certainty in advance with the tax authorities on the tax treatment of certain aspects. We have a 100% participation exemption, so a full exemption on capital gains and on dividends. We have a broad domestic withholding tax exemption when a Dutch BV pays out dividends. We have a favorable expat tax program for personal income tax. And we are fully aligned, as well as France, I think, with the international developments in the OECD and the EU initiatives, which you can also see in our international developments, which we already touched base on today, like all the BEPS and Pillar 1 and Pillar 2 initiatives, ATAD 1 and ATAD 2 that has been implemented, and also DAC 6 and DAC 7, the digital service taxes on platform companies. So, for example, Airbnb, Booking.com, those companies. We have a new conditional withholding tax on interest and royalties from 2021 if this is paid to low tax jurisdictions or allocated to low tax jurisdictions. And more or less the same will be introduced for dividends as from 2024, but only in case it will be paid to low tax jurisdictions. So that is good to bear in mind. And at the corporate tax level, we have new anti-mismatch rules on transfer pricing. So briefly, when we had a loan between two related entities, and on this loan in the Netherlands, we did not pay any interest to the creditor of this loan, we were able to impute any interest because that should have been in line with the at arm's length principle. So then if an at arm's length interest should have been 5, we could have deducted 5, even though we did not pay the 5. And now that is not possible anymore. It should only be possible if you can prove that the recipient did really include that interest in its corporate tax base. So that is new, and that is something which is interesting. We also have the interest deduction limitation rules for affiliated companies, some anti-abuse rules. So, for example, if there is a tainted transaction, such as a dividend distribution, a capital contribution, or an acquisition, the interest may not be deductible. And what is also important is, as from this January of this year, the EBITDA rule, which we know from ATAD 1 in the EU, the percentage of 30% has been decreased to 20%. So we only have a threshold of 1 million of interest that may be deductible. And in addition, we can use 20% now, and that was 30%. So that is a rule that has quite some impact, I think. And of course, we have an innovation box regime, and we have a pending proposal of an exit taxation, which means if your company in the Netherlands will leave the Netherlands, for example, by virtue of a cross-border merger or by the change of a statutory receipt, and that moves to a so-called qualifying country, you may be taxed for an exit tax. I know, I mean, it's still a proposal, but because of the retroactive force, I mention it because if it will pass the parliament, it will become law. So if you move your company now out of the Netherlands and it will later become law, you still are captured by this proposal. So that is also quite impactful, maybe. Some brief points on the coalition agreement for 21 till 25. There are some key points which are at the radar of the Dutch government. So, for example, combating tax avoidance, and I think that's there already for quite a few years if you see how many new legislation has been introduced. The steps taken by the government in this area will largely stem from international cooperation, which we already have seen, of course. And the Netherlands is therefore actively working together to find solutions in an international context aimed at combating tax avoidance. What I briefly mentioned is we will also introduce a digital service tax for DAX 7. Minimum rate for profit tax, that is of course the pillar 2, but it's not sure yet how many extra tax revenue that will generate. So if that is not resulting in a desired revenue, other means of base broadening or adjustment of the low corporate income tax rate or adjustment of the SIT bracket length of the 395,000 euro will be considered. And of course, the climate for businesses and the position of small, medium enterprises will be taken into account. But that is still to be seen what will happen with that, but that's on the radar. And lastly, a CFC measure. We already have CFC legislation in our law. However, there has been a recommendation of a committee that says maybe we should also apply CFC rules if a income is not distributed. So, for example, the current CFC rules will only include the income if it didn't distribute. So if you didn't So if you did distribute a dividend, it will not be captured by CFC rules. And now they would like to change that even though you distribute your income, it will still be captured by CFC measures. So that is also something which may be introduced in the future. But I think the most, for the practice, the most interesting adjustment as from last January is the adjustment of the loss compensation rules. What F already indicated is, I think it is inspired on the French regulation, but for the Dutch entities, it may be new. So I will briefly walk through this. So it is introduced as from 1 January, and we have a threshold of 1 million. So that is always compensable. And after that million, only 50% of the profit may be offset against the losses. And the remainder of the losses can be forward indefinitely. And that is different than we had before. We had a carry forward compensation term of 9 or 6 years, but it was limited. And before 1 January, the losses remain compensable for 9 years, like the old rules. And losses incurred as from 1 January 2013 are now, in principle, compensable, can be compensated indefinitely. So that's different than the rules we had. But it's good to bear in mind that only you can compensate your losses in case you were in a profit-making position in this year, except for the 1 million threshold. And to give it a more background, we made a small example to demonstrate how this will work out. So we have a taxpayer here who has in year 1 a profit of 1 million. You can see it's green. We have in year 2 a loss of 4 million. And in year 3, we have again a profit of 4 million. So in the end, there's a profit of 1 million. Well, under the new rules, what can we do? In year 1, there's a profit of 1 million. So that's there. Year 2, we have a loss of 4 million, and we would like to offset the 1 million of last year with the loss of year 2. That's only possible for €1 due to the 1 million due to the threshold. So then we have 1 million compensated from year 1, and we still have a loss of 3 million in year 2. And then in year 3, we have a profit of 4 million, and we still have some losses of 3 million. So in year 4, we first take the threshold of 1 million, which we may compensate. Then we have 3 million of profit left. 50% of 3 million is 1.5 million. So then we have 1.5 million from the profit and 1 million from the threshold. So in the end, 2.5 million is the maximum losses we may compensate in year 3, even though we have 3 million of losses. So in the end, we may compensate 2.5 million in year 3, leading to a taxable profit of 1.5 million and leading to a carry forward of 0.5 million of losses, which we can forward indefinitely. So I think it's good to see the difference. What I said, we only have 1 million profit within 3 years. And in the old rules, we were able then to compensate all the losses and pay 250,000 euros tax, assuming a 25% tax rate. And now with the new rules, we have a taxable profit of 1.5 million, leading to 375,000 taxes. So that is a difference of 125. So I think this may be impactful for some organizations. So this, I think this will have a lot of impact. So that is good to have a closer look. And I think then we are at the priorities of the cabinet, and I think I may give the floor to Jan-Willem.
Excellent, thanks, Faye. Yeah, we already touched upon what was in the coalition agreement. So that's the bit longer term perspective of the new cabinet, the new government that we got since the end of last year. Now we're looking at a recent letter from the cabinet on what are their key priorities for now. And I think it's good to touch a bit on that, because we know that legislation will follow very shortly on this. So most likely this Prinsjesdag, our Dutch budget day. So the 5 priorities which are in there, the environment, I think that's a very, very, very important one for the Dutch politics at the moment. So even taking a closer look at CO2 taxation with pricing on that, and making sure that the CO2 emission goes down. There's a fascinating aspect there, the interaction between the European CO2 trading system and the Dutch system, plus also, of course, the new system being introduced by the EU, the CBAM, the Carbon Border Adjustment Mechanism. So all 3 items highly relevant for those industries that are emitting CO2. So please take a close look at not only the EU aspects there, but also at the individual country, especially the Netherlands. On business taxation, the Netherlands has a policy of being fully aligned with international taxation, but it also fully supports that. So we do see full support for the Pillar 1 and Pillar 2 approach from the OECD, active contributions to the discussions in the OECD, but also active support towards implementing Pillar 2. And we believe that Pillar 2 is a bit on a, it's not completely clear where it will go to and when exactly. It needs to be enacted ASAP, because that's agreed on the OECD. And also the directive is there clearly. Our understanding from Brussels is that they really want to get it all sorted effectively this week, if at all possible, to make sure that indeed all the timelines can be kept. And there is also a lot of push on the French, we understood from Brussels, because the thought is that the French presidency of the European Council is able to get through a lot of those tax proposals, while maybe the next few presidencies, well, there is a bit less faith in that it will also happen that quickly as the French will do. So we can expect a lot within the next few months, I would say, and maybe even given the elections coming up in France, maybe even a lot within the next month. There's a local item on business succession, which is a priority. There's always a lot of discussion on how to move business from one generation to another or to a different party, making sure that that's can be done such that it's not hurting the business. And labor and income tax, the policy of our government is a relief of the tax burden there. Wealth tax is a very important item in the Netherlands, given a landmark decision from our Supreme Court, which effectively rendered our system of box 3, which effectively is the individual taxation on capital. They rendered that not solid, so it cannot be upheld. So that means that remediation needs to take place, a new system needs to come up, but also a remedy for the past needs to come up. So if you're in the personal situation that you have a box 3 tax payments to make for the last years, please pay close attention, because it's not unlikely that there will be a refund there. The move would be from a forfait, what we used to do, what is your wealth, and it was just an effective taxation on that, on deemed income, moving much more to a real income taxation. And that especially relates to, well, if you have bank accounts, the interest is clearly measurable, but also the real estate. I think those are the key points to mention here. And yeah, as I mentioned, the developments go very, very quickly at the moment. So there is a big need in the Netherlands to do something about the environment, and there's a big commitment from government as well. And that may also include additional taxation there. That's where I would like to leave it with the session for EU, French and Dutch tax. And there are a couple of questions, but Sylvie, may I hand over to you?
Yes, of course. Thank you very much. Well, thanks first of all to all of you, Faye, Eve, Romain, Jan-Willem, for sharing your expertise with us. I think you have to be a tax expert to really understand everything, I have to be honest, but indeed very interesting. And I think a lot is going on EU level. Maybe start by the question that was in the chat by Rinse van Minne. It was a question asked during Eve's presentation on the amortization of goodwill. The question was...
Yeah.
Yes.
Okay, so the question was maybe on the scope of the amortization. So it is applicable when you acquired what we called a fonds commercial. So it's really for a set deal. It's not possible when you are acquiring companies, or I mean shares. It is only applicable when you acquire assets.
Underlying assets.
If there are any questions, you can also now put your camera and your microphone on and ask this question directly to one of the speakers. Well, while you're thinking, maybe I can ask a question. I have the feeling that now it's much more on EU level, what's going to be implemented for the taxes. I know that in the Netherlands, we're always seen as a fiscal paradise. Does that mean that it will change as well, the position of the Netherlands?
It's a good question, Sylvie. And I think that if we take a look at what is the tax haven nowadays, that must be France, because they have a lower tax rate, right? Yeah. But maybe that's a too simple answer. Now, I think generally speaking, much more is going to be aligned within a European context, and all the favorable tax regimes that individual countries had, they will slowly fall away. I'm convinced that ultimately we are moving towards much more European taxation, European common tax base. And that is already happening step by step by aligning the anti-abuse legislation, still giving countries the possibility to add on that anti-abuse legislation from their own perspective. but the possibility to compete very much on specific tax regimes is going to be limited. And I don't see the Netherlands doing that going forward either. So it's relatively going to be harmonized. What is going to be the big differentiator ultimately? That may be the tax rate. And we do see within Western Europe quite aligned around the 25% mark nowadays. We see the Eastern European countries with a lower tax rate, and Ireland clearly there as well. But that seems to be, if you think a bit further, the main differentiator from a tax perspective. So the real competition takes place on where do you want to do business, how good is your business environment, how good education do you have, infrastructure, etc. And I think ultimately that's where the Netherlands is well placed, and we don't need maybe that hard anymore. Also those tax competitive items.
Thank you, Jan-Willem. I see we have 4 minutes left. So if you want to ask a question directly, please use the time now. In the meantime, we also had a question, I think it was answered by Jan-Willem during his speech already, that we will give you the handout afterwards. You will also find the presentation again online. It's recorded. And of course, the PowerPoint presentation as well. So that will be sent to you. If there are no more questions, I think we can wrap up. So, well, thank you very much, Eve, Faye, Jan-Willem, and Romain, and also Michel van Den for organizing this event with us. The first of our event of the French Week. So I think we can officially declare the French Week as opened. And I wish you all a great day, a great week, and I hope to see you soon and also in person. Merci beaucoup à vous tous et j'espère vous revoir en présentiel très bientôt et passer une belle journée et belle semaine. Merci beaucoup.
Merci, au revoir.
Thank you.